Most people think life insurance is only about what happens when you die. And for most policies sold, that's exactly what it is. But there's a small category of permanent life insurance that wealthy families use very differently, not as protection, as infrastructure. And before you assume this is another financial loophole or get-rich-quick strategy, it's not. It's expensive, it's slow, and it fails miserably if it's used incorrectly. But when it's structured properly and used for the right reasons, it becomes something most people never realize life insurance can be. A private financial system. Today I'm going to show you exactly how it works, who it's for, who it absolutely is not for, and the mistakes almost everyone makes. No hype, no selling, just how the strategy actually works. Section 1. What the family bank really is. The family bank isn't a product you buy, it's a strategy. One that uses specially designed permanent life insurance to do three things at the same time: store capital, provide liquidity, transfer wealth efficiently. Instead of keeping excess savings in a traditional bank account, you fund a permanent life insurance policy that's designed to maximize cash value, not death benefit. That policy becomes a place where money can grow steadily, a source of collateral you can borrow against, and a long-term wealth transfer tool. You control the funding, you control the borrowing, you control the repayment. And let me be clear about what this is not. It's not better than investing. It's not a replacement for your 401k, and it's not a secret the wealthy are hiding. It's a tool, and like any tool, it only works in the right hands. Section 2. How the mechanics actually work. When a policy is designed correctly, a portion of every dollar you contribute builds cash value. That cash value grows at a guaranteed minimum rate, usually around 3 to 4%, may receive additional dividends depending on the insurer, does not drop during market crashes, and compounds tax-deferred. On paper, that sounds fine. Here's the part most people don't tell you. The early years are brutal. If you contribute $30,000 in year one, your cash value might only be $18,000. That's not a scam. That's commissions, fees, and insurance costs. Permanent insurance is front-loaded. It takes time to mature, and it often takes 10 to 15 years just to break even. If you need flexibility in the short term, this strategy will punish you. Section 3. Policy loans and the real math. This is where the strategy becomes interesting. When you need access to money, you don't withdraw from the policy. You borrow against it. When you take a policy loan, your cash value keeps growing. You pay interest, usually between 5 and 8%. There's no credit check, and you decide how and when to repay. Now let's address the obvious objection. If your cash value grows at 4% and you borrow at 6%, you're paying a 2% spread. So why would anyone do this? Because the goal isn't cheap money. The goal is control. You maintain liquidity without interrupting compounding. You avoid triggering taxes. You don't have to sell investments during a downturn, and you're building a death benefit at the same time. It's not mathematically optimal. It's strategically useful. Section 4. Who this actually makes sense for this strategy only works for a narrow group of people. Good candidates include high earners who've already maxed out retirement accounts, business owners who need flexible collateral, families with estate planning concerns, extremely conservative savers who value guarantees, and people thinking in multi-generational timeframes. Bad candidates include anyone carrying consumer debt, anyone who hasn't funded basic retirement vehicles, anyone needing access to the money within 10 years, anyone chasing high returns, and anyone unwilling to commit long-term. If you're in that second group, this is not for you. Go fund your Roth IRA first. Section 5. Real numbers, real comparison. Let's look at an example. A 40-year-old contributes $30,000 per year for 10 years. Total contributions, $300,000. By year 5, cash value is roughly $120,000. Borrowing access is about $108,000. By year 10, cash value is around $310,000. By year 20, cash value grows to roughly $580,000. Death benefit is about $1.2 million. Now compare that to investing the same amount in an S&P 500 index fund averaging 10%. Year 10, over 500,000. Year 20, nearly 2 million. The market wins on returns. So why would anyone choose the policy? Because returns aren't the only objective. The death benefit adds tax-free leverage. The value never goes backward. Liquidity doesn't depend on market conditions, and it complements other assets instead of replacing them. Section 6. How wealthy families actually use this. Wealthy families don't use this to beat the market. They use it to reduce friction, for business financing, for real estate down payments, for college funding flexibility, for emergency reserves, for estate efficiency. It's not an investment replacement, it's financial infrastructure. Section 7. Whole life versus IUL. Two policy types are commonly used. Whole life offers predictability, guarantees, and stability. Indexed universal life offers more upside, more complexity, and more moving parts. Neither is inherently better. The real determinant is policy design. Most policies are built to maximize commissions. Family bank policies are built to maximize early cash value. That difference matters more than the label. Section 8. The death benefit multiplier. Here's where the strategy becomes powerful. If you accumulate $500,000 in cash value and carry a $1.5 million death benefit, even with outstanding loans, your heirs still receive over $1 million tax-free. They inherit both the asset and the advantage of how it was used. That's real leverage. Section 9. The truth most sales pitches. Commissions are high. Liquidity is limited early. Loans aren't free. Terms can change. Discipline is required. Opportunity cost is real. Anyone who ignores these realities is selling, not advising. Section 10. My actual recommendation. Before considering this strategy, max out retirement accounts. Build an emergency fund. Eliminate high-interest debt. Speak to a fee-only advisor. Review multiple illustrations. Commit long-term. If you can't do all of that, don't do this. The family bank isn't a shortcut. It's not magic. It's not for everyone. But in the right situation, for the right person with the right structure, it can be a powerful supporting pillar in a larger wealth strategy. Not the system, just one piece of it. If you want part 2, where I break down real policy illustrations and show you red flags to avoid, comment part 2 below. And subscribe for financial content built on clarity, not hype. Because the best financial decisions aren't emotional, they're informed.